Good afternoon, all of you. So there's a small delay due to some technical issues. So however, we have now started the lecture. So last time we discussed about the term structure of interest rates. I think today also we are going to just discuss about it, and we need to get some idea about the physical implications of that term structure of interest rates. And it involves some power calculations, so that we need to have some practice on those things. Then not only that, we need to see how we can apply those things into the real situations, and the types of methodologies we can use in order to get the inflation expectation calculations and forward rate calculations and all that. So that we started last time, and we had some type of formulas, and those formulas we didn't have much time to practice those things, but I think through the practice only we can get the idea of those things into your normal thinking pattern, and it can be applied in most of the situations. And at the same time, I want to just tell something about the new interest rate scenarios now. On 20th of January, there was a policy statement made by the Central Bank of Sri Lanka, the Monetary Committee of the Central Bank. They have made a policy statement with regard to the policy interest rates. The policy interest rate has been enhanced by 50 basis points. So that means now the SLDR and the SLFR been increased by 50 basis points, and now it stood at 6.50 and 5.50. 6.50 is the lending rate, and 5.50 is the deposit rate. That is an increase as from the earlier interest rates. It's a 50 basis point or 0.5% increase. I think that really have some effect on the call money market and the money market. So that, of course, now those are the types of expectations. I mean, when the policy interest rates been increased, there can be a effect on other interest rates. So those are the realistic situations, and we can get an idea about those things by looking at the formulas, what we have already discussed last time with regard to these interest rate term interest rate calculations. So we can go to the lessons. Now, there you have some hypotheses. One is the expectations hypothesis, the other one is the liquidity premium hypothesis and segmentation hypothesis. Now, we focus our studies on the expectation hypothesis because it involves certain hypotheses where we can go through the forward rates or future interest rates. So actually now last time we discussed about this thing, the market interest rate is equal to real interest rate, that is the interest rate applicable for the capital, then the expected rate of inflation and the various risk premiums. Those are the components of market interest rate. So the real interest rate is the core of that. Then there can be an addition of expected inflation rate and the various risk premiums. Now, the policy statement really explained the reason of enhancing the policy rates. Why 50 basis points? Because they just took the idea of inflation, the expected rate of inflation continuously going up. Because of that reason, the policy rates have been increased. So now you can see the market interest rate really have that effect. Then there can be other risk premiums also, but those risk premiums are not taken into consideration into these policy rates. It is only the expected rate of inflation. So I think you can just consider it as a real life situation of applicability of the term interest rates. Now there can be several other risk factors we need to take into consideration when you decide the YTM or yield to maturity. The default risk is one, the liquidity risk is the other one, the interest rate risk is the other one, and the foreign exchange risk. Now those are the different components of risk with regard to the determination of interest rates. Then there's a thing called yield spreads. The yield spread is a amount where you charge higher than the risk-free type of an instrument. Yield spreads are the differences in yields between risky bonds and default-free government treasury bonds of similar maturity. For example, suppose an AAA grade corporate bonds current YTM is 11%, while the YTM on a similar T bond is 9%. The yield spread for the pair of bonds is 2%. So what you mean by this is now you have taken two types of bonds. One bond is an AAA grade corporate bond, the other one is a treasury bond, same maturity, but AAA grade corporate bonds YTM is 11%, whereas the T bonds, the same maturity T bond is only 9%. So there's a difference of 2%. That 2% is called the yield spread for this bond. Now it says yield spreads tend to vary over the business cycle. They are larger at business troughs than at peaks. So in the business cycle, you can come across several ups and downs. When business is doing well, these spreads are normally becoming lower. Whereas when the business is not doing well, the types of these spreads will come, it will go up. That is how it happens. It really happens in a predictable fashion. As a result, the bond traders and investors who can act quickly when yield spreads appear to be different from normal can make profits. So that is how they normally behave, because they vigilantly look at the market and see what type of expectations are in the market, where they can predict what type of spread changes would happen in the market. So that would help, or that would enable them to do whatever the investments they can and get some profits through these investments. Now, as the theories, we have already explained these things in the earlier session, but I can just explain it again, because I think that day we didn't have much time to discuss on these things, but today we can have a better discussion on expectation hypothesis and that type of a thing. Now it's like this. Now when you say YTM, now YTM N means the nth year YTM. So there can be several years we are taking into consideration, and say if you have YTMs for several years, say YTM 1 is the YTM for the first year, YTM for the second year would be YTM 2, YTM for the third year would be YTM 3, likewise, you can put it that way. And at the same time, when you start with the first year's interest rate, there can be an interest rate we can just predict as the forward rate. So if you predict an interest rate for the second year, taking into consideration the first year. So that type of a forward rate is taken as F12. F12 means you just get the forward rate with respect to year 1 on year 2. So that is what it means, F12. F23 is in the year 3, what is the expectation in the year 3, what is the interest rate, the expectation of interest rate when you look at it from year 2. So that is what you mean by F23. So this particular notifications or this types of notations we need to understand. So you can just look at it and see, to start with the YTM of the first year, and then you need to have the multiplication with all the future rates up to the nth year or 10th year, whatever. So for example, say if you have YTMs for several years, so year number 1 the YTM is so much, year number 2 the YTM is so much, that way you will have it. So in other words, we can have a notation for YTM. So YTM 1 is the year number 1's YTM. YTM 2 is the year number 2's YTM. So likewise, you can have these YTMs taken into consideration. But what we need to do is, we need to get the future, forward rates calculated from different dates. Now, in that case, if you take the first year, that is the YTM 1, in the first year, the YTM is equal to the forward rate. Because it's like this. Now, if you have predicted the forward rate from the earlier year, that is the year number 0, if you did that, then it would be YTM that that is being taken as the forward rate. So therefore, when you start the things like that, you start in that manner. So I will just explain it on the board. So I think you might get a good idea about it when I explain it on the board. So I will do that now. These are the notations for different things. YTM is the yield to maturity. Then you have the forward rate. Now, when you say forward rate, there's a special notification or notation. So notation is, now say there can be several years like this. Year 1, 2, 3, 4, 5. When you say year 1, 2, 3, 4, 5, then you have YTM. Now, if I put the YTMs as this, say 7%, 7.5%, 9%, 10%, and 12%. Now, say these are the YTMs for these years. There are 5 years, and for each of these years, you will have a YTM. Right. Now, you can say the forward rate. Now, if you take the forward rate for year 1, that is the forward rate, you just look at it from the year 0. So we put it as F01. When I say F12, this is the second year's forward rate when you look at it from year number 1, F12. This is F23. Now, this notation you need to understand in a proper way. Then this, what is the this thing? F34. This is F45. Now you just look at it, and that really gives you a good understanding about these things, the future rates or forward rates. We call it forward rates. Now, when a forward rate is given, there's a special notation. Now, if you put the first year's forward rate, now that is F01. So you need to get that forward rate predicted from the year number 0. To get the second year's forward rate, that is forward F12. So likewise, you can put all these things in that notation. Now, can you remember? Now we did an exercise last day. Now say, just look at these things. Right. Now the forward rates are given here. Now what is this? Now when you take the F12 means this one. So when I put this one here. Now, yeah. So this is the place where you just get the forward rate. So that forward rate is not notified as F12, right? This is F12. So this is the second year's forward rate with respect to the first year. Now this is the first year's forward rate with respect to year 0. Now what is 9.77? It is how do you just give a notation for this? Just to give a notation for 9.77. What is that? F in F terms, what is that? F23. That is F23. And here there's a calculation for F12 and F34 also. Now just look at it that way. F12 we can calculate by 1 plus YTM2 to the power 2 divided by 1 plus YTM1 minus 1. So that gives the F12. So F12 means this. Now the hand signal is there, no? So that is the F12. So now you can give a notation for 9.77. What is 9.77? That should be F23. F23. Right. Now by using equation, now this equation is a result of this theory. Result of this theory. You can just look at it. I will show it for only for 3 years. Then you will get it that way, right? Only for 3 years I will put it on the board, right? Now just look at it. Now I can just write it this way. YTM say 5 is equal to YTM 1 into 1 plus F12 into 1 plus F23 into 1 plus F34 into there is another one here 1 plus F45. Now this has to be taken together this way. 1, 2, 3, 4, 5. There are 5 terms. So therefore, you need to take the 5th root minus 1. Will give this answer. Will give this answer. Right. So this is how the formula is being given in a simple form, and simple form in the sense here we have taken only 5 years, but in the formula the n years been taken. And there's another implication here.
Sir, this excuse me, this YTM5, this is bit is not bit clear, like YTM1, then within brackets 1 plus F12, is it?
Yeah. One
Then
in, yeah.
1 plus F23.
Yeah.
Okay, 4, 5.
Yeah.
Okay, right.
So now you can just look at the particular trend or the
Okay.
pattern. The
Okay.
pattern is now you have 1, 2, then 2, 3, then 3, 3, 4, then 4, 5. That is how it goes.
2, 3, 2, 3, 4,
2,
5.
3. No. After 2, 3, you get the 3, 4.
Okay, okay.
And then again you get 4, 5. So you always get the same number. Now say, now I can just show the first one, that is F12. No,
Yeah.
F12, the second number is 2. So when the next one starts from 2, F23. Then the other one starts with 3. No, then we call it as F34. Then the other one starts with 4, F45. So that is how it goes.
Okay.
So you need to identify that pattern. That is the pattern. So that pattern you have to apply.
Okay.
Right. Now the same mathematical expression can be given in different forms. So you can just look at the equation B. Equation A, now I have really explained the equation A. Now I just want to tell you, or just want to give you the equation B. So how do you get it? The equation B. Now that comes as, now if you want to get the T minus 1 and T, the forward rate, if I apply some numbers here, so then I can say it is F23, right? I will put it as F23. So then what is the T is equal to 3 in that case, F23. So how can you put it? So you can say F23 is equal to 1 plus YTM3 to the power 3 divided by 1 plus YTM2 to the power 2. So that is what you mean by that. Minus 1. That will give you the F23. So then there's another way of getting it. If you have more than one type of difference, say, if I say F35, what is the meaning of that? F35. If you say F35, that is the forward rate of year 5 as you look at it from year 3. So that is what it means, F35. So what is F35 then? 1 plus YTM 5 divided by 1 plus YTM 3. So that is, you have to the power also, you have to decide that way. 1 plus YTM 5 to the power 5 divided by 1 plus YTM 3 to the power 3 square root of, that is square root. So 5 minus 3 is 2, no? So that is the square root. So then that way you have to put it. I will show that. I will show that how we can get it. Now with this now if you get a forward rate like this, F say 4, 5. Now the meaning here is it is the forward rate for year 5. In year, so that is the meaning. F45 is the forward rate for year 5 in year 4. When you look at year 5 from year 4, so that is the forward rate. So the notation is given as F4 5. If we put F3 4, that is forward rate for year 4 in year 3. Now here what we do is we just go into only 1 year forward. That is an easy task. That is not a difficult task, so that is an easy task. So how do we just do the calculation? Now we can just take these things into consideration. So if I put it that way, now if I want to say that I want to get F23, now F23, how do you get F23? F23 is equal 1 plus YTM 3 to the power 3 divided by 1 plus YTM 2 to the power 2. Right? Then you have to get the square root of this. Minus 1. So that comes as the answer. Right? I think so. This is the one you need to focus your mind. This is the third year's forward rate. When you look at it from year 2, that can be calculated by 1 plus YTM 3 to the power 3 divided by 1 plus YTM 2 to the power 2 minus 1. So how can you do that? So we can just look at it. And what is YTM 3? It is 9%. What is YTM 2? It is 7.5%. So we can apply those things there. So when you put it that way, 1 plus YTM 3 means YTM 3 is this 9%, 1.09 to the power 3 divided by what is YTM 2? That is 7.5. Then we can write it 1 plus 0.075. That is 1.075 to the power 2 minus 1. So this will give the forward rate of year number 3. This will give the forward rate of year number 3. Right now, again, we will go to the lesson. Okay. Invariably, they have not get the F23 here, but F12 is calculated. Now, this is the way it has been calculated. Now, you just look at it the way it is been done. 1 plus YTM2 comes in the numerator, and 1 plus YTM1 comes in the denominator. And you have to get the power also according to this. I mean, since the number here is 2, the power comes as 2. Now with the calculations, you will get this answer. That is the answer for forward rate on year number 2. So here we can write it as 8%. Now if you go to the next one, that is for year 2023. Year 2023 means now this year. That is Y4 or year number 4. So that is been denoted as F34. Then first one is 1 plus YTM4 to the power 4. divide by 1 plus YTM3 to the power 3 minus 1. Then you do the substitutions and get the answer as 9.25. So the 9.25 should be written, that is F45, no? F45. That should be written where? It should be written here. Here. The number 5 column. Number 5 line, it is to be written here. I think now that is understood, no? And there's another type of a thing which we need to understand. Now, rather than having a forward rate for only 1 year, what we can do is we can have a forward rate for starting from a particular year for a period of number of years. For example, you can have a forward rate from the year 10 for 20-year bond. So that type of thing. 10-year, we call it a 10-year forward rate. 10-year forward rate from year 10. So that, such type of a thing. So we will do such type of exercises and see how it can be done. Right now, I can just give you an example of that nature. The YTM on a 7-year T-bond is 9%. So that is YTM 7 is 9%, and YTM on a 10-year T-bond is 10.5. So you can say YTM 10, 10.5. Determine the implied average forward rate for a 3-year T-bond starting in year 8. So what is the meaning of that? Starting in year 8 means you need to get the forward rate of 3 years from year 7. So that we can put it as, you can notate as, notify as F710. F710. Can you look at that? F710. Now that is how it comes here. F710. Now what is the meaning of F710? Determine the implied average forward rate for a 3-year T-bond starting in year 8. So the time period is 3 years. It is started in year 8 means look at it from the at the end of the 7th year. Starting in year 8 means now you have to look at it from the 7th year, the end of 7th year. So starting in year 10, it is that. So that is how it is been given. So you get the value like this, because you know the YTM 10 is given in the question. YTM on a 10-year T-bond is 10.5. So YTM 10 is 10.5. And YTM on a 7-year T-bond is 9%. So that means YTM 7. YTM 7 is equal to 9%. Now we have the data as YTM 10 as 10.5, YTM 7 as 9%. So then how are we going to, what are we going to calculate? We are going to calculate F710, because the duration of the bond would be 3 years. From which year we are going to get the calculation? From 7th year end. So that is what you mean by starting in year 8. That is how the 3-year period is measured. So then the equation comes as this: F710, 1 plus YTM 10 divided by 1 plus YTM, not only that, 1 plus YTM 10 to the power 10 divided by 1 plus YTM 7 to the power 7 minus 1. So since it is 10 and 7, 10 minus 7 is 3, and you have to get the third root. or the cube root of this. This is the average for year 8, 9th and 10th at an annual rate. It's a 14.8 rate. So we call it a 3-year bonds forward rate when you look at it from 7th year. And if you look at the third one, if the YTM on a 20-year T-bond is 10%, so then that is YTM 20 is equal to 10%. And similar 10-year T-bonds are yielding 10.5. That means YTM 10 is equal to 10.5. What is the rate on a 10-year T-bond starting in year 11? So then what should we get? Can you put the notation of F, which is appropriate for the third one, third sum or third problem? Can you write it? Now what they need is to get the rate on a 10-year T-bond starting in year 11. So how can you notify it? How can you notate it? What F terms? In which F terms it can be notated? Now say earlier one we put it as F17. Now in this case, what is the way we put it? Yes. What is the way we put it? Just do it. Just do it. Yes. In formula, there's nothing called F55, no? Wait, I will just see. There's nothing called F55. Anyway, I will answer your questions, Asanka. So difference between yield and interest rate. No, it's a very simple thing, because when you say interest rate, it is the rate the yield comes. What do you mean by yield? Yield is the return you get. Interest rate is the quantification of yield. That is the only answer I can give you. Yield means what? Yield. Yield is now in Sinhala we call it asfan. Yielding is asfan. What you get from your approving at the day. So that is what you mean by yield. Interest rate is the quantification of that. I think you got my point. It is the quantification, the number. Yield is also a number, but when someone asks you what is the yield, so you give the interest rate. So that rate you get the yield. That is what it means. Okay, I think that gives an idea. Then you asked me what is the meaning of 5-5. So I have not given anything like that anyway. Just look at it. Formula, we say you are referring to the formula number A. So there's no 5-5, no. But there's no, it won't come. Such type of thing will not come, because here the formula means ft minus 1t. So therefore the two suffix should not be equal. Nothing I have given as F55. So I don't know. Asanka, what did you mean by that? What did you mean by that? Mean by F55? So have I mentioned anything about F55 here in the formula A? Yes, Asanka. Because always when you say F and forward rate, these two numbers should be different. It should not come as F55. It should always come as F45, not 55. It should be 45. That is the formulas. This formula has given in that manner. No? Always t minus 1 and t. So that is what we get. So therefore, there is no question of having F55. It cannot be having in that way. Asanka, are you okay with that? Right. Now we'll go to the question again. Right, tell me now when this particular question is taken into consideration, the question number question number 3. Now it says if the YTM on a 20-year T-bond is 10% and similar 10-year T-bonds are yielding 10.5. Similar means the same type of 10-year bonds. 20-year bond is same government issued that. That is what it means. So 20-year bonds YTM is 10%. 10-year bonds YTM is 10.5. So yielding means the interest rate. So YTM. If you keep it till maturity, you might yield that amount. That is what you mean by yield to maturity. What is the rate on a 10-year T-bond starting in year 11? So 10-year T-bond starting in year 11 means it will have a duration of, or not duration, tenor of 10 years. That is what it means. So you need to get the rate of that. So how do you get it? And what is the amount you need to calculate? F what? Now here you get F17 in the earlier question. So likewise, what is the thing you need to get here in the third question? So just give that answer. Not. No, on the board, I have not mentioned anything like that. Here you have F4, 5, F3, 4. 4, 5, 3, 4. I have not mentioned anything as F5, 5. And Asanta, now the third, not on the board. In Formula 8, I think I erased that. Okay, I think if that is the case, I think you might have a, it's a visual problem, I think, maybe, but it should not come as that. There's nothing, there's no question of coming F55 because there won't be anything like that. I think I have made a mistake. Either I have made a mistake or the particular, it's a visual error or whatever. Right. But this is not the answer for the third question. Now I think you try it again, not 10, 11. Because you are referring to another 10-year period. So therefore, how are we going to put it? Not 10, 11. Your attempt is okay. I mean, good attempt, but the answer is not that. Anyone else you can just try and see what is that? Not 10, 11. Because that particular thing should have a tenor of another 10 years. That is what it means. Then it should be what? Very good. F1020. It should be F1020. Right. Now, if you put it as F1020, so how can you construct the formula? So I will just put that formula on the board. Now we are going to calculate F10, 20. F10, 20, right? So it should be equal to 1 plus YTM 20 to the power 20 divided by 1 plus YTM 10 to the power 10, the root 10th root minus 1. So this should be the formula. This should be the formula. F1020 equals to 1 plus YTM 20 to the power 20 divided by 1 plus YTM 10 to the power 10. Now 20 minus 10 would be 10, so the root of 10 minus 1. So this is how you calculate F10, 1020. So we have YTM 20, it is given, and YTM 10 is also given. So what is YTM 20? It is 10.5 or something like that. Meaning of root. Yeah, because it's a GMR, no, geometric mean return. So therefore, the average, right? I think your comment is correct. It's correct. It is for average purpose. Correct. That is why now, if you go to the formula again, you will see that, because if you take into consideration 10-year period, there will be 10 powers, no? So therefore, that you should get the 10th root. If you go for 9 years, you should get the 9th root. That is how this the meaning comes. Okay, that's correct. That's correct. Right now, in this sum, you have yes, 20-year T bond, YTM on a 20-year T bond is 10%. So therefore, YTM 20 is equal to 10%. YTM 20 is equal to 10%. YTM 20 is equal to 10%. What else? Then it says and similar 10-year T bonds are yielding 10.5. 10-year bond means YTM 10 is 10.5. YTM 10 is 10.5. Then you can apply these things into the, or substitute the things into the right. 1 plus YTM 20 is, that is 10% means 0.10, 1.10 to the power 20 divided by 1.105. 1.105 to the power 10 minus 1. 1.10 to the power 20 divided by 1.105 to the power 10. And what is the root? 10th root. 20 minus 10 is 10. 10th root. Right. So shall we do the calculation and see what happens? Yes. Do the calculation and see. Right, now you just do the calculation and see what is happening there. What you need to do is you need to get 1.10 to the power 20, then 1.105 to the power 10. This has to be divided and then should be taken the 10th root. So, and that really involves some amount of calculation or calculator work that you need to practice. So just look at it and see whether you get the answer. Just get the calculation done. Or others should involve this for this calculation. I mean, if you just take a calculator and do it, and then you get the practice also. And I told you that everywhere now in this particular type of questions you have to do power calculations. Of course, now that has to be practiced. .5. Yes, we will see. Correct, correct. Point 1.10 over 20. Yes, the answer is correct. 9.5 is the answer. So you have any issue with calculating the powers? So either you can use a Casio or any other calculator. Now, when you go for the calculation, you will see. First of all, you get the 1.10 to the power 20. So how are you going to do that? 1.10. When you press the button XY, x to the power y, that button you have to press. Now I am having a Casio calculator, FX100 calculator. So then you need to press x to the power y, and then you have to put the term 20 to the power 20, no? So 20 then equals to. So that comes as 6.7274 something. And it is to be divided by 1.105. 1.105 to the power 10. So then you have to get x to the power y pressed and 10. And you say equal to. You get a value 2.4787 something. And there you get the 10th root of that particular answer. 10th root. If you get the 10th root, so how are you going to get it? So either you can get the shift and then press XY again, and 10, you have to put 10. Or what you can do is you can just press x to the power y and say press 10, but you have to do the reciprocal of 10 and press the equal mark. Then you get 1.095, because your answer would come after deducting 1 from that. Then you get the answer 0.0950. So that means as a percentage it is 9.5. So I think that is the way it is to be calculated. Okay. Right. I think Ruchira and Asanta got the answer. What about the others? Have you calculated that? Because you just try the calculations with your calculators, because it's a good practice you need to get. Because at the examination also, you have to apply these ideas and then just calculate it. Right. Right. I will just give you a data, give you some data with regard to yield to maturity and years to maturity, and I will ask some questions on that. Then I think you can have a good practice on this. I just put the things on the board. Anything, you need any demonstration the way I got the answer? Others, are you satisfied with the way the answer? Yes, Ruchira.
Sir, here now the question is YTM on a 20-year bond is 10. Similar, 10-year bond is yielding at 10.5. What is the rate on 10-year T bond starting in 11?
Year 11, yes. Year 11, yes.
That is why we got the F10, comma
20.
20. That means
That is the reason.
forward rate of year 20 in year 10.
Yeah, very good. Yeah, but it's like this. But
Okay.
year 20 is correct. But what are you going to do is now, when you look at it on the point of view of year 10, so that means the duration or the tenor of the tree bond would be 10 years. That is how we take it. So anyway, what you are saying is correct, because we are looking at a 20-year bond. That's correct. When you look at a 20-year bond from year 10, that will be the answer.
Okay.
That okay? Right. Now, shall we? I think we can have another question answered on this. I will put the data on the board. You have years to maturity and yield to maturity. 1, 2, 3, 4, 6, 10. 1, 2, 3, 4, 6, 10. Then you have yields 7, 8, 8.5, 7, 8, 8.5, 9, 10, and 11.5. 9, 10, 11.5. So these are the years to maturity. That means in the left hand side you get years to maturity. That is 1, 2, 3, 4, 6, and 10. Then you have the corresponding yields to maturity. For the 1 year one, it is 7%. 2 year one, it is 8%. 3 year one, it is 8.5%. 4 year one, it is 9%. 6 year one, it is 10%. 10 year one, it is 11.5. So that is how the yield to maturities are taken. Now, first question would be, determine the implied forward rate for year 2. Implied forward rate means when you look at it from year 1. So that is what it means, right? Determine the implied forward rate for year 2. That is the first question. Determine the implied forward rate for year 2. So this is the first question. Just do it. Determine the implied forward rate for year 2. Asank, have you now you have asked a question, but I can't. It's not very clear for me. Can you talk and tell me? Same tenor means what? No, if a bond is taken and if there's a tenor, the tenor is given, so then we are in a position to calculate the yield to maturity, no? So that we can do. But these future rates and all, those are called implied rates. Those are not that realistic, but those are called implied rates. It's a futuristic valuation. Right, now look at it and the question, can you get the answer for that? Because you have the yields for yield to maturity or whatever that YTM. For first year you have it and second year also you have it. But what you need to do is you need to get the implied forward rate for year 2. So if you put it in F terms, how do you put it? If you put it in F term, how do you put it? Simple thing. Yes, very good. F12, correct. Now then do the calculation and see what it is. F12, correct. Shankar. No, now if you go to the formula, what happens is you get, because we are referring to F12, that means the second year versus first year. So when you say second year, then you need to get to the numerator 1 plus YTM2 squared. 1 plus YTM2 squared. What is YTM2? That is a 2-year YTM, that is 8%. Then it should come as 1.08 to the power 2 divided by 1.07. There's no square roots or whatever. Just to put it that way, minus 1. So, and you should get something else, not 4.41. Kuchira also got it. How did you get it? You need not take it as square root, right? Yes, because I think you took it as square root. Now, no need of taking square roots. In the formula, it doesn't say that. No need of a square root. That square comes only when you have more than 2 years gap. 2 or more than 2 year gap. If you have more than 2 year gap only, you get the the root. Otherwise, you don't get the root. Right. Yes, the answer is correct. Ruchira's answer correct. 9.01 is correct. Now you can understand that if you make a mistake, then you realize what is the correct thing. If you don't make a mistake, you won't understand that. That is the issue. So therefore, I think making mistakes would be very much good for your health, because you really learn something from that. Okay. Because there's no root business here, because you are only referring to 2 consecutive years. But if you take more than a 2-year gap, 2-year or higher, say for example, you are referring to a bond of, say, on the 3rd year you refer to another 2-year bond. So that means you should take the 5th year YTM. Then you need to take the square root, right? So then if you just look at another one from the 3rd year, end of 3rd year, if you look at say 6th year bond, then what is the root you should take? 3. 3rd root you have to take. So likewise, you need to do that. But it will not apply for 2 consecutive years. 2 consecutive years, it will not apply. Right, good. So then the next question would be, this will give you a good fun, and at the same time you learn. Now, right. Now you just determine the implied forward rate for year 4. Implied forward rate for year 4 also. Find implied forward rate for year 4. Year 4. Just do it for year 4. There you get YTM 4. 1.09 to the power 4 divided by 1.085. Yes. Now do that also. That is the implied forward rate for year 4. So year 4, how do you put in terms of F for year 4? That should be F34. Yes, good. So now calculate it. That will be 1 plus YTM4 to the power 4 divided by 1 plus YTM3 to the power 3 minus 1. Yes, I think it is not that difficult for you to calculate the F34. Yes, Asanka, Ruchira. Others also, you should try. If anyone needs any demonstration on the board, I think I can do that. But I have to see the requirement, because if people do not need that, I should not waste my energy. Yes, Ruchira, do the calculation and see what is the answer. That's a simple one, because the way you did the earlier one, the same way you can do this. The first thing you need to get, that is Y4, YTM4. YTM4 is equal to 9%, I think. Yes. So then it would be 1.09, 1.09 to the power 4 divided by 1.085, that is F3, or the YTM3, 1.085 to the power 3. Minus 1. Ruchira, can you try that? I think the other people also should try, yeah? You try and do it, and then it is good for you, all of you. Since this is a little, people are not very familiar with this calculation, that is why I just ask you to do it. And you will get your things, get your familiarization there. So that familiarization will help you to take decisions. Today,
Sir,
decision making activity. Yes.
here now square root thing will come to play when there are a number of months, number of years. Is it?
More than one. More than one. If the number of years, the gap is more than 1 year, it would come.
You mean 3 to 6, 3 to 8, 1 to 9?
That way. Yes, yes, yes.
Okay.
Yes. Now here only 3 to 4, no? The duration is only 1 year.
Okay. Okay. That is the trigger point, no? That is
Yeah.
the.
That is the point. That is the point. Since this involves some power calculations, I think people sometimes, if they are not very familiar with this, then they might find it difficult at the beginning. So that's what that type of difficulties you can get over by doing this. That is why I just ask you to do the calculations and do the exercises on your own. And what I want to tell others also the same, because all of you should engage in these things. Then only you can learn something. And it's really very interesting, if you learn something. So how interesting you feel. You feel very satisfied, if you learn new things. And you try, yes. Yes, very good. Yes. Krichira's answer is correct. 10.51, yes. Yes, Asanka, try it and see whether you can get the answer. Yes, good. Yeah, that is Asanka's question. Actually, he asked whether when you say F14, only difference is applied root 3. Yes, yes, yes. Yes, that is correct. Right. Now we will go to a little uh, different type of implied calculation. So I will put it this way. Determine the implied yield on a 2-year bond at the start of year 5. That I will erase these things. Now this time you need to do determine implied yield on a 2-year bond. Determine the implied yield on a 2-year bond. 2-year bond at the start of year 5. At the start of year 5. So these are uh, little challenging type of a question. So how can you do it? Now I will repeat the question. Determine the implied yield on a 2-year bond at the start of year 5. When I say at the start of year 5, it is equal to after the end of year 4. Then the 2-year duration comes with that gap. So just tell me what is the F notation for that? No. I think there's a small mistake.
So question, can you repeat it again?
Yeah, I will determine the implied yield on a 2-year bond at the start of year 5. At the start of year 5. Determine the implied yield on a 2-year bond at the start of year 5. So that means the 2-year bond starts from the 5th year, but you look at it from the year end of 4. That is what you need to look at. Not 4.7. It should be 4.6. Because now if you say 4.7, the duration or the gap could be 3 years. But they are not referring to 3-year bond. They are referring to a 2-year bond. So therefore it would be 4.6. Is that okay? Right. 4.6. It would be 4.6. Now again you can look at it and just get the confirmation or get it confirmed. Like since it is a 2-year bond at the start of year 5. At the start of year 5 means now the 2-year bond starting from year 5, beginning of year 5. That means you have to look at it from the end of year 4. So when you say 4 and 6, you get the gap, 2-year gap. Right. So do the calculation on that basis, that is F46. Now there you get root. There you get root. Why? The difference is 2. It is more than 1. Then you get the square root. Right, do the calculation and see whether it is getting the answer. Yes. Very good. Ruchira, your answer is correct. Good. 12.03. Now, what I am asking is anyone of the other people, if they need any demonstrations on this, I can do that. If you don't need it, so I can just keep quiet. No issue. Right. Then we can go to the next question. Right. I will put that also. Determine the implied yield on a 4-year one at the start of year 7. Four-year one. And the start of the 7th year of year 7. Right. So you should start with F notation. What is F notation you have to use here? Very good. F610, correct. Very good. The root should be 4, yes. And do the calculation for that also. And make sure you all are very much conversant with these F notations. That will help you to apply the correct formula. Getting the F notation is the most important thing here. If you got it wrong, then your formula would also be wrong. Right. Now with that, can you do the calculation? Yes, very good. Asankar, yes. Ruchira also got it. Yes, very good. Now, I think now you got it, no? Right, right. I am happy. You got it. Right. Now we will go for a more challenging type of a thing. Right. We can just again go to the exercises in the lesson. Right. I am very much concerned about the others also, because they also should join with this and then get their things. The practice also should be very much necessary for the others. Yes,
So,
Ruchira.
so
Yeah.
what is the practical like usage of these
Yeah.
calculation? Like
The usage is actually now when you do the predictions on interest rates, say it is very much important for asset liability management. That is why we do this type of things. In the asset liability management committees or whatever, now they always make predictions on interest rates, and even for bonds or whatever. Now, say for example, now if a particular decision to be taken with regard to a certain thing maturing on a particular date or whatever, in a future date. So then on a future date, what would be the investment we are going to make? So that type of an decision can be taken today by looking at these forward rates. That is what you mean by that. Interpolation, yes. No, it is really not like interpolation of it, because interpolation, if you do an interpolation, that's a type of a, you have to have a curve, no, yield curve or whatever. But here we are not going to have an yield curve, but we do get some type of forward rates calculated. That forward rate is not equivalent to a interpolation
that
per
mean
se.
you using this particular forward rate, we decide are we going to buy currently, are we going to buy more bonds or uh, something like that, is it?
Yeah, yeah, of course, yes. Because you are, I mean, it's a supporting thing for your decision. Because now you can take a decision with that information, and that decision would be very much rational and very much what do you say, very much advantageous. That is why we do it in especially in this asset liability management committees, alcos. This type of things being taken into consideration, because I have seen in several real life situations where the treasury people, they talk in terms of their bond portfolios, their interest rates and all, and they have these projected type of interest rates for the future. The assumption is actually Yes. Uh, the assumption is really the exponential type of thing where we don't assume the linearity. So that is the thing. That is why we go for these power calculations. There's no linearity assumption, but we go by, as you say, I think Asanka has said something about getting average or whatever. But this average is a different average where you go by the geometric mean return or whatever. So that is the basis. Now, for example, if you go for a linear relationship, there your thing is you go by the proportionate thing. But here we don't go by linearity. We go by exponential theory. So there you go by the powers. That is the difference. So assumption, actually, there's no such assumption here. Only thing is now, it really, the assumption is really, we can say, it follows an exponential function. That is what the assumption. If you need to have what is the assumption or whatever, so I can give that answer for that. The assumption is the particular forward rates follow an exponential function. It is not a linear function. Yes.
Now, practically, if you are like practically, if you need to
Yeah.
get the actual amounts, where can we get these years to maturity,
Yeah.
years to maturity? Those facts, where can we get down?
Yeah. That can be obtained. That can be obtained because now those things can be calculated on the basis of certain things. No. Now, for example, say we just calculate sometimes it's accrued interest rates and all those things. So such things we calculate, no. So they are in the same manner. We can calculate for any bonds or whatever. If you know the starting date and the ending date, and what is the coupon rates or whatever, so then we are in a position to get the into maturity calculated. There's nothing wrong, nothing difficult in that, because if you have the necessary inputs, you are in a position to calculate yield to maturity for any bond, even if it starts in another in a future date. Because what you have to do is you have to just apply the conditions which are relevant to the particular situation. If you do that, then you can calculate the YT.
Now, 2 year yield, 2 year yield is 8.
Yeah,
Say, to fourth year forward rate is 10%.
yeah, yeah,
Now the meaning is in the forward the rate will go up by 2%.
yeah, of course.
Then
Yes.
that mean your value of the particular bond will increase, something like that.
Yeah, yeah, of course. Yes.
Okay.
Yes.
Then currently
No,
you
value
can.
increase means now say right now. I think you have come to the particular correct point where when you YTM increase, what will happen to the value of the one? When the YTM or when the forward rate increases means the YTM. Now
Yes.
the forward rate would say, if you go for a forward rate of the next the second year. So now we are in 2022 now. If you get the forward rate for 2024, right? So in that year, what will happen if the rate is higher? So what does that mean? The value of the bond, what will happen to the value of the bond?
Come come
It will come
down.
down. It will come down. So that is what's happening. That is what's happening. But only thing now that that really comes with the today's situation or today's conditions. But that can be changed in next year. So that is the situations. But what are we going to do? I mean, when you arrive at the forward rates by looking at today's rates. That is the only the base now we have. But as you say, there can be changes. Why? Because in time to come, the ground situation might change. With that, the projected thing would be different in the next year. So that is how it comes. But anyway, now when you take a decision, what we need to do is we need to take the decision on the basis of present conditions. But only thing is now, say, after taking that decision, if you feel that, say, another very short period of time, say, in a 1 week's time, the whole thing has been changed, then you have to take that decision again, because you have to correct that. You get my point? So that is how now it's a very dynamic type of situation. You can't just wait and see that will happen or whatever, but you need to just you have to arrange or adjust yourself to different types of situations. Because in any type of predictions or any type of sensitivity analysis or whatever, what you normally do is you just think there's only one thing going to be changed. All others remain constant. So that is one type of an assumption. So, but in reality, it won't happen. But there's no other way of doing it. But however, that type of things sometimes make sense. Even though we say that now, sometimes in sensitive analysis, what we do is we just assume that a particular factor is going to be changed, while all other factors are remaining constant. That is the normal assumption. But do you think that it happens in reality? No. But it sometimes a similar, or we can say closely similar thing might happen. Even though some changes happen, the highest change happened in what we have selected. So that is how the things are coming. So therefore, in these assumptions or whatever, we have to satisfy ourselves with what our assumptions. Now, in this particular case, as you say, the assumption here is the yields really follow an exponential function. That is the assumption. Right now, if you go to the this thing again, the exercise. Now we can go to the question number 4. Yeah, it says, suppose the real rate is fixed at 3%. If the following inflation rates are expected for each of the next 5 years, determine the yield curve for the risk-free bonds. So how are we going to answer this? Now these expected inflations are given, right? Expected inflations are given. Now what happens is, the risk-free rates actually, even though you deal with the risk-free bond, the inflation would have an impact on that. That is what you need to understand here. Now, you have expected inflation for each year. For first year number 1, the expected inflation is 4%. Year number 2, expected inflation is 4.5%. And year number 3, the expected inflation is 5%. Now, inflation is going up and up, but in year number 5 only, it has come down again to 5.5. Right. Now, what we need to do here is, you need to calculate the expected inflation when you look at it from first year. And you can say expected inflation for the second year would be 1 plus 0.04 into 1 plus 0.045, the square root of that minus 1. So that would be the second year's expected inflation for 2 years. I mean, we called it 2 years. 2-year expected inflation is that. 3-year expected inflation would be 1.04 into 1.045 into 1.05, the third root minus 1. And 4th year inflation would be, now how are we going to put it? Now, when we say expected inflation, you give it year by year. Year 1 expected inflation is so on, that is 4%. Year 2 expected inflation is 4.5. Year 3 expected inflation is 5. Year 4 expected inflation is 6. Year 5 expected inflation is 5.5. Now, what we are now going to do is, we need to get the 1-year inflation, 2-year inflation, and we call it 2-year expected inflation. Right? 2-year expected inflation, 3-year expected inflation. So that is how we get the calculations. So how are we going to do it? Just calculate the 2-year expected inflation. As I told you earlier, what is 2-year expected inflation? We don't call it, we call it expected inflation for 2 years. Expected inflation for 3 years. That way we call it. Right. Now you have to start with expected inflation for 1 year. That is 4. That is still 4. Then you have to say expected inflation for 2 years. It is not the 2-year expected inflation, for 2 years we have to say. You are going to calculate it for 2 years. That is what it means. Then how do you calculate that? 1.04 into 1.045, the square root minus 1. So that is how you calculate it. That is how you calculate it. And just do the calculation and see what it is. Just do the calculation and see what it is. Yeah, what you need to do is, you need to get 1.04 into 1.045. And you need to get the square root of that. Minus 1. And that comes as 4.249. So we can put it as 4.25. That is the inflation rate for 2 years. That is the inflation rate for 2 years. Right. Now, in the same way, can you calculate the inflation rate for 3 years? Now, I have already calculated the inflation rate for 2 years. Now, you should calculate the interest rate for 3 years. What is that? Yes, but this has to be 1 plus. 1 plus, okay? 1 plus 0.04 into 1 plus 0.05 square root. That is how the square root has to be taken. Minus 1. It always that way, right? Don't just multiply the rates. Always you have to multiply 1 plus the rate. So then it would be, you would get it. I think the answer would be that 4.25. Coming back to the discussion. Right. I don't know. Have you done the 2 year for 2 years inflation and for 3 years inflation, 4 years inflation and the 5-year inflation? So that is what you need to do. But of course, now when you look at the way it is calculated, you realize that it is the GMR, geometric mean return for those years. Now say, if you want to get the inflation for 2 years, you need to get the first and second years rates, the yields or whatever, and get the GMR, geometric mean return, same thing. If you go for 3 years inflation also, you have to get first year, second year and third year inflations and get the GMR of that, geometric mean return. So in the same manner, you do the same thing for 4 years, 5 years and all. So therefore, what I feel is now, it is not a big thing. So what you have to say is, you just do the calculation and see what is the value, what is the averages for, average in the sense the mean, geometric mean average for different types of years. So what is the value you got for 2 years? Have you got it? Yes. Have you got it? Yes, Ruchira. Now what you need to do is, you need to get
1.0.
Yeah.
1.04 into 1.045.
Yeah.
Then
you have to get the square root of that.
Okay.
Square root of that minus 1. That is what you do. That is the same as GMR. No, I think you can remember, no, when we calculated the geometric mean return, you have followed the same method. You have followed the same method. Now what we are now doing here is, we are getting the geometric mean return for 2 years, geometric mean return for 3 years, geometric mean return for 4 years. Likewise, we get this. That is what we have done. So then, what is the geometric mean return for 2 years? Yes. What is geometric mean return for 2 years? Now that you can get 1.04 into 1.04 into 1.045, is it 1.045? And you need to get the answer and get the square root of it and minus 1. Then you get an answer 4.249. So it is, you can say 4.25. That is the answer. 4.25 would be the inflation rate for 2 years. 4.25. So in the same manner, you calculate the inflation rate for 3 years. What is that? There you get 1.04 into 1.0425 into 1.05, 045. And there you get this cube root, third root, minus 1. So that by doing that, you would get the 3-year inflation rate. 3-year average inflation rate in that case. Yes, Sankar and Ruchira, you do the calculation and see what are the values. 4.25 you get for 2-year mean inflation rates. 3-year mean inflation rate comes as what? Yes, very good. 4.5. Ruchira, yes. That is a 3-year mean rate. 3-year mean rate. Sankar, you are correct. For 2-year you get 4.25. And what is 4-year? 4-year mean rate, mean inflation rate, 4-year. There you get sorry. We have to get the expected inflations, those things you have to get. For 3-year one, I think I don't know whether I made a mistake. 1.04 into 1.045 into 1.05. Yes, that is the value. 1.04 into 1.045 into 1.05. Square root, cube root. Yes, 4.4. 4.5 is the answer, right? Correct. Okay, now, yeah, what is the other one? Yeah, 4.89. That is the inflation rate, mean inflation rate for 4 years. 4.89. Just to see. There, what you need to do is, you need to get 1.04 into 1.045 into 1.05 into 1.06. So there you get the fourth root. Fourth root to be taken. So you can say xy 4. Yes. No, it's not 4.89. Just to check it again. For 4 years, it is not 4.89. There's a small change, small mistake. Yes, Ruchira. Now you got 4.19 for the 5th year or 4th year? 4th year, it is not 4.89. Close answer, but there's a mistake. The second decimal is wrong. So just do it again. So what to do here is, you start with 1.04 into 1.045 into 1.05 into 1.06. So that is the thing which we need to do we are going to have for 4 years. And that answer you get as 1.2096, and there you have to get the fourth root. Fourth root. Yes. Now when you get the fourth root, you get the value 1.048723. So then you have to take out 1 from that. The answer would be 4.87. Yes. Yes, Ruchira. 4.87 is the answer. Asanka, just check it and correct it. Okay, then you go to 5 years. There also you do 1.04 into 1.045 into 1.05 into 1.06 into 1.055. 055. So that you get 1.276136 something. And there you have to get the fifth root. Fifth root. And the fifth root would you would take it as 1.0499. And the answer would be 5%. Basically, yeah, 4.99, correct. I think now we can tabulate the things. Now they say the real rate is fixed at 3%. Now yield curve for risk-free rate, now we have to prepare. I will do it on the board. I will do it on the board. Now, first of all, I can say, I will go through the normal notation. Right. The years are given. There are 5 years altogether. 1, 2, 3, 4, 5. Then you have real rate. And we put it as RR. It's taken as 3%. And now we have already calculated the expected inflation rate for different years. So that is, we can denote as Q, simple Q. So for the first year, it is 4%. For the second year, it is 4.25. For the third year, it is, we have already calculated these things, 4.5. And for the fourth year, 4.87. These things we have already calculated, right? Then the last one, 5.00. Right. Now, in actual form, we get the rate, or we call it risk-free rate. So how do you get the risk-free rate? You can add these two things, because you have not added any risk here. We have added only the inflation expectation. Now, of course, now I can just give a very good example as what happened in Sri Lanka. Even though the policy rate's been increased by 50 basis points, it is not the actual inflation, expected inflation, right? It has I think the inflation has gone up by several basis points. I mean, not several, is about, say, about 200 or 300 basis points. It has been increased. Whereas it is only reflected in the policy rates by only 50 basis points. So that shows that in time to come, next 1 or 2 months time, invariably there would be another increase. Another increase would be there. So then you can just see the risk-free rate will go up with the inflation expectations. So what is the risk-free rate for year 1? 3 plus 4, that is 7. That is 7. So we can say risk-free rate, you can calculate by R plus RR plus Q. Real rate plus inflation is the risk-free rate. So then here you get 7%. Here you get 7.25%. Here you get 7.5%. Here you get 7.87%. Here you get 8%. Now it's an increase. If you look at the year 1 and year 5, it has been increased from 7 to 8 during the period. And what do you mean by the yield curve? In the question, now it is asked about the yield curve. So anyway, we can go to the question also. Right. Now determine the yield curve for the risk-free bonds. Now the yield curve, what do you mean by yield curve? Now yield curve is a particular curve or a graph prepared on the time versus yield. Time versus yield. Now what do you mean by time? 1, 2, 3, 4, 5 years. And the respective rate being plotted. So that is what you mean by the yield curve. Yield curve for risk-free bonds. So if I put it in a graphical form, it comes like this. Now you can say the time can be taken into the x-axis, yield can be taken into the y-axis, right? And let's see. We can note here, note 1, 2, 3, 4, 5, and respective risk-free rates, 7%. So we can just put it this way: 2, 4, 6, 8. So when it is 1 year, it is 7%. Somewhere here. When it is 2 year, 7.25. When it is 3 years, 7.5. 3 years, 7.5. 4, 7.87. 578 is something like this. Something like this. So that is the yield curve. I think it's a nearly flat type of a yield curve, but there's no big change. It's a flat type of a yield curve. I think now you can really look at it, that form. So yes. No, it's also giving forward rates. But in the yield curve, what I think you are asking the same question again. I think earlier also you asked that question. Now, I think what you are saying is correct, because we are referring to forward rates. But in an yield curve, what we do is we just interpolate, extrapolate, and get the notional rates, right? But in forward rate calculations, what we have done now with this average in or whatever, geometric mean average. So that way, we have not interpolated. We have assumed that yields are really in an exponential function. That is why we do it. Now, yield curves, forward rate calculation or whatever is done through the extrapolation. And there we assume some linearity. Whereas in forward rate calculations, our assumption is the exponential function. That is the difference. I think that that particular thing answers your question. It is also given forward rate. That's correct. Yeah. All right. And I can just give you another indication of these rates and practical importance of this calculation. And say, for example, you all should understand that the bond dealers in different organizations, especially financial organizations, they have to be very vigilant on the movements of interest rates, on economic activities, and different types of macroeconomic and microeconomic indicators. For what? In order to have an idea about the movements of interest rates. So that's a very important thing for a dealer, especially a bond dealer, because they deal with bonds, and in order to get a higher trade-off, they deal with bonds, and not only that, they deal with the interest rates of bonds. And according to the interest rates, they do several types of investments or several types of trading in order to have a higher return. And since they are competent enough to predict the interest rates, they would be in a position to earn substantial amount of profits. Right. Now I will just take a certain example of some dealing activity. So for that, I have to just give some demonstration on the board. Say, Now there are two bonds. One. Then price and maturity. These are the three items that we have to go through. Now, one bond is called ABC. That is issued by a corporate called ABC. The other one is XYZ. The price is given here, not the yield. And it is 900,000 rupees. And the other one is 785,000 rupees. Right. Maturity is 1 year. It is 1 year maturity. This is 2 year maturity. Right. Right. You can just look at it. So there are two bonds. One is called ABC, that is issued by the corporate called ABC. The other one is XYZ, it is issued by the corporate called XYZ. That ABC's bonds priced at 900,000 rupees and its face value is 1 million. Two bonds face, all the two bonds, 1 million face value each. Face value is 1 million for each one. Right. Now the question is this. Now I will put it on the board. And these bonds are zero coupon bonds. Now all these two bonds are zero coupon. Zero coupon bonds. Zero coupon bonds. Right? And the question is this: show how the forward rate starting in year 2 could be locked in by a bond trader. Show how the forward rate. Show how the forward rate starting in year 2. Starting in year 2. Year 2 could be locked in by a bond trader. Could be locked in by a bond trader. Right. Now this is the question. Now I will tell you what are the implications having or getting from this particular question. Now I think you might wonder, what do you mean by how the forward rate starting in year 2 could be locked in by a bond trader? What do you mean by that? Locked in by a bond deal. Now locked in means now how that particular bond dealer realizes profit by dealing with this bond. That is what it means. Right now, I think you can see the two bonds. One is 1 year, the other one is 2 years. So, in order to get an idea about what you should do, first of all, what you need to do. That is my question. Because it's a discussion, right? Now, we have two bonds. You know the price of the bond, and there's another data on that is those both are zero coupon bonds, and the prices are given. And the question is how forward rate starting in year 2 could be locked in by a trader. So then for that, we need to know what is the forward rate for 2 years, second year. So in F terms, what is it? In F terms, what is it? We are going to now calculate. Yes. In F terms, what is it? Because we are referring to 2-year bond and 1-year bond.
F12.
F12, very good. F12. That is what you referring to as the forward rate. But in order to calculate that, what should we know? What should we know? In order to calculate F12, we need to have YTM2 and YTM1. What is YTM2? The 2-year bonds YTM is taken as YTM2. 1-year bonds YTM is taken as YTM1. So then our next task is to calculate YTM2 and YTM1. Now I think the easier calculation is for YTM1. So you do that and see what is it. Now, of course, you know the face value of these two bonds. Both are 1 million valued. And it's the first one, that is 1-year bond, is 900,000 rupees. Which means what is the YTM of that bond? I think that is the first thing you need to do. You need to calculate the YTM1 or 1-year bonds YTM. Now I think now Asanka's question can be answered by just demonstrating this question. There can be several things, but one tool can be explained through this question. Not only that, I think I just told you about the duration and that type of techniques. So in addition to these duration techniques, this is also another way. Just for day-to-day deals, yes. Yes, now, can you answer my question? Now, I asked, what is the YTM1 or the 1-year bonds YTM? It is so simple. Yeah. So simple. How do you get it? Yes, Rujiran. I think it's so simple. I think you can just do it without any issue. And it's a 0 coupon bond. In face value is 1 million. Price is 900,000. It's a discounted bond, is it? Since it is discounted at a discounted price because it's lower than the face value, the price. Yes, tell me the YTM for 1-year bond. How did you get it?
Face value divided by price.
Face value divided by price. Yes. Yes. Then what should we do?
It's called
Face value, yeah. Face value divided by price. What do you get now? Okay. 1000 divided by 900.
1.1.
Yeah, 1 million. Sorry. 1 million divided by 900,000.
1.1.
Yeah, 1.11, right?
Yeah.
So then what is the rate? What is the YTM can be taken here -1. You can just -1. Then what is the YTM?
Okay.
0.1111. That is 11.11. 11.11.
Yes.
That is the YTM. Yes, correct. That is the YTM. It is not how did you get 5.41?
That is square root one. But
Huh?
that's
Pardon?
that is square root. That should not taken. Yeah.
No square root.
Yes.
It is not necessary. No necessity of square root here because it's just getting the YTM. In other words, say if you do a more simpler one, it's like this. Now say your price is 900,000 and your this thing is 100, so 1 million, and 100,000 is the rate of interest, right? 100,000 divided by 900,000. That gives you the yield YTM. That gives you the YTM. So that is same 11.11. So 0.1111. So that is how the answer is obtained, right? It's so simple, so simple, right? Now you can note it. The YTM one for the 1 year bonds YTM is 11.11. Say YTM 11.1%. So the next task is to get the YTM2 calculated. The 2-year bonds YTM, that also has to be calculated. So what shall we do? How shall we calculate that? There also you go by the simple logics. What is the simple logic here? Yes. What is the simple logic? Now the price is 785,000 and face value is 1 million. What is the interest amount? Yes. What is the amount of interest here? Yes. Now that interest would be taken in 2 years. Is it? Yeah. However, now you need to have the interest calculated. What is the interest? Yes. 215,000. Yes. And what is the investment? The investment is 785,000. So then you need to calculate the ratio 215,000 divided by 785,000. That is the investment, right? Then you get 0.2738. But what is that? That is for 2 years. So then you get the square root of that would give you the .2738. Now you get the square root of that -1. Sorry, square root of that would be taken as 0.52. Sorry. Now it's like this. Now you got a value of 0.27 something for that calculation. I'll put it again. So your interest is 215,000 and your investment is 785,000, and this is for 2 years, and the rate or the yield would be 0.27 plus 1. Not only that, you have to get the square root of that. And minus that. You have to put a minus for that. And with that, what is the value you get for the YTM? What is the YTM for this 2-year one? 12, very good. 12.87. 12.87. Right. Okay. I will put that on the board. 12.87. Right. So this is YTM1. This is YTM2. So with that data, just calculate the forward rate for 2-year one. 2-year forward rate, or 2-year forward rate. Starting in year 2. That is F21, no? Sorry, F12. So how do you get F12 from this? Yes, F12 from this. Now we know the YTM1 and YTM2. Then what is the calculation of F12? And just do the calculation for the forward rate starting in year 2 or 2 years. In the second year, what is the forward rate? In other words, in the notation, we can say F12. F12 equals to what? So that we can calculate the forward rate starting in year 2. What is that? Because you have YTM1 and YTM2. And you know the formula for F12 in terms of YTM1 and YTM2. So write down that F12 is equal to what? Yes, 1.11 to the power 2 divided by 1.1287 to the power 1. Yes, minus 1. Yes, yes. Okay. Okay, now do the calculation and see what is the answer. That is correct. The answer is correct. This expression is correct, and you need to get the answer. So 1.127 to the power 1 is 1.127 itself. And what you need to do is you need to get the square of 1.11. Square of 1.11. That comes as 1.2321. So in the numerator, you get 1.2321 divided by 1.1287. So you get an answer 1.0916. Sorry. You get YTM 1 plus YTM 2 squared. 1.11 squared, correct. Sorry. You need to get the other way, because 1.1287 to be squared, not 1.11, because you need to get the YTM 1 plus YTM 2 squared in the numerator. The other way. You have taken it the other way. Right. 1.12787 to be raised to the power of 2. 1.1287 to the power 2 divided by 1.11 minus 1. That would be the answer. I think you have taken it upside down. That is the issue. So then you need to get 1.1287 square. That that is to be divided by 1.11. 1111, right? You get 1.14657 and minus 1 is also there. So then you get 0.1466. So then the forward rate starting from year 2 is 14.66. 14.66. 14.6667 years. You can say 14.67 years. 14 points. No, 66. It should be 66, not 67, because you get the answer as 0.146578. So therefore, 5 will become 6 if you go for 4 decimals. 14.66. Yes, that is the answer. That is the forward rate starting in year 2. It is 14.66. So I will put that number here. Forward rate starting in year 2. We calculated as 14.66. Yes. Now there's a thing called in the bond market. Right. Right. Now I think we need to have a good idea about these transactions. Now it is asked, how do you lock this interest rate? 14.66. What a bond dealer can do is, now there's a thing called short selling. I think I have just given this explanation at the beginning of these lessons. There's a thing called short selling. What do you mean by short selling? Short selling is, now you sell a bond by borrowing something from someone. That is what you mean by short selling. Without having it with you, you can sell it. So how do you then sell it? You borrow it from someone and sell it. So
is it permitted in the Sri Lanka?
No, it is not permitted in Sri Lanka.
It is not permitted.
Yeah. In Sri Lanka, it is not permitted, but in international markets, it is permitted.
Okay.
So therefore, we have to learn these things. But in somewhere or other, it might really the particular regulations can be changed.
Okay.
So therefore, we have to learn that, because it's a type of activity where the bond dealers can execute. But in Sri Lanka, it is not permitted yet. But I think in time to come, it might, because the thing is now, the Sri Lanka is in a soup-like thing where we need to just experience or examine several things, several ways, or several alternatives. That is the reason. That is now. Asanka's now he has given a comment, can sell a bond with the promise of fire. So buying back means now we call it a repurchase agreement. repurchase agreement, right? So that is selling with an agreement to repurchase it. So that is a repo. That is a repo. So repos are permitted, but it is not a short sell. It is not a short sell. Repos are permitted. In outright market, yes, it is, permitted. Repos are permitted, but only thing is now in the Sri Lankan repo market, it's a short term one, very short term, 3 months, 6 months, and even 1 year. Repos are there, but it's very low amount in longer term repos. But you have repos, the overnight repos are there, 1 month repos are there, that type of repos are there. But it is not short selling. Now, short selling is you sell something with the promise of settling it on a particular day. With the promise of settling it on a particular day. Right. So then what this person has to do is he has to short sell the 900,000 one. That is 1 year one. It is to be short sell. Now with the short selling, he would receive 900,000 worth of cash. Is that clear? Right. Now I think this is a very interesting point to note, where the person would sell it even without it. That is what you mean by short selling. He short sells, and some other it is happening, and so he just would get 900,000 rupees for that. That is sales proceeds. And what he will do is he will purchase a 2-year bond at the price of 785,000. So how many bonds he can purchase at that price? Because now he has 900,000 rupees with him, with the proceeds of the short selling. And using that 900,000, he would purchase that particular bill priced at 785,000. So how many bonds he can purchase on that? Tell me the way it can be done, the calculation. How many bonds means 1 and point something? No, that is not what it happens. How it happens? Because 900 is higher than 785, no? So then, yes, very good. So then 900,000 divided by 785,000. So then what is the value there you get? 900,000 divided by 785,000. That comes as 1.1465. We can say 1.1465. So that means by selling short 900,000 worth bond, you will get 1.1465 of 785 price bond. Is that clear? Right? 1.1465 of 785,000 bond purchased. Right? Purchase been made now. Then he gets 1.1465 of the bond, which is priced at 785,000 today. Right? So that has happened. Then what will happen on maturity? On maturity, what will happen? Because on maturity means so then when you get the proceeds of the bond, right, on maturity, say on maturity you would get 1.1465 bonds. So in other words, you get 1,146,500 value for that. So out of that, you can redeem or you can pay back the 900,000. Even though you short sell it for 900,000, you have to pay 1,000. No, 1 million you have to pay. In order to settle that, you have to pay 1 million. So out of this 1.146 1.146,500,000 bond, you have to pay 1 million. So then you get 146,500 with you. That will remain with you. So that is the profit gained by that transaction, by locking that interest. So that 40.66 the amount is that. I think you got my point. Very interesting type of a thing where you can just get an idea about the types of transactions a bond dealer can make. So what is his gain then? His gain is 146,500 for the second year, because that has to be matured, no, in order to do that. So, but he has to redeem, or he has to settle the 900,000 worth bond with the proceeds of a 2-year bond. So that is the amount, the whole amount, so 1 million. But you would receive 1,146,500. So from 1,146,500, you paid the 1 million in order to redeem that bond. But you will retain 146,500. So that is your gain. That is how you log the interest. That is the starting in year 2. The rate or the yield starting in year 2 is that. Okay, I think that's the type of transaction you would do in order to have such type of lock-in or whatever. But I think you can see the reality here. So why you do this? Now I'm asking you a question. Why shouldn't that person or the particular bond trader, whatever, who did the other way about? Why didn't he done the other way? Because now here what we did was we just short sell the ABC bond. But whereas if he did short sell in the XYZ bond, what will happen? Yes. If he short sell the XYZ bond, what would he receive? He will receive only 785,000 rather than 900,000. Then he would, how much of the bond he can recover? He would not even recover a particular one bond even. It's a fraction of a bond only he can recover, or he can get with that proceeds. That is the reason. So therefore, now if you have 2 bonds priced in 2 different prices, you have to short sell the high price one, not the low price one. Got my point? That is how we have to do it. Otherwise, you will not get a gain. You will lose. That is the case. If it is the other way about. So that is why now the particular one trader has to clearly think on what he is doing. And he needs to have a proper idea on different fundamental issues of bond trading. No, short selling actually there's no weight as such. Of course, now when it is done, now say if it is an advantageous type of a transaction only, it would be done. Otherwise, it would not be done. So that is the weight really. The weight for yield means now say, for example, now it's high yielding actually. No, it's like this. Now invariably it will happen. No. Now here there are two bonds. Now 900,000 is one, the other one is 785. When you say 785, and it is of course the high yield is that. So high yield in one, you have to purchase. Low yield in one, you have to sell. That is what it the other way, right? So if you get that type of a principle also, it is valid. Now since you have asked that question. Now when you say the yield, you have to deal with or you have to sell the low yield bond and purchase the high yield bond. That is what you do. Then only you can gain something. Right. Anything else you need to clarify? Only thing now today, the discussion only the involvement with the discussion is only by Asanka and Ruchira. So others also should have some type of engagement. I don't know whether they might have done those things, but it is not being seen. Anyway, I earnestly think that you all join with these activities and you did your own work and be familiar with these things, and then it is very much easy for you to answer the questions. There can be people who later follow the lecture in the recording. I normally do not recommend that particular practice because it's not that fruitful or not that possible, because when you just follow a lecture, you would get all the expressions and all type of what to say, that the incidental type of questions and answers. That would be a better way. Lively participating in the discussion. And if you have any queries or whatever, you can ask that. No, you can ask any query. You can clarify any query. So therefore, it is the best way. But if you have some issues or whatever, and you are not in a position to follow the lecture, then only you can do that. Don't make it a practice. Yes. Anything else you need to clarify on that? Yeah. Yes, Rajira.
So that the amount, can you clarify it again? I lost the connection that you 1.1 million amount.
Right. Now, actually, now we have two bonds. Now, one bond valued at 900,000 as the price, and the other one is 785,000. Now, here the bond dealer did was now he just short sell the 900,000 bond. Now,
Okay.
my question was why the deal was done that way. Because if he did the other way, he would lose from this. Whereas since he has done this way, he gained from that. Now, what is the reason? Now, 900,000 is the bond with higher price. 785,000 bond is a low price bond. So, high price bond, what he did was he just sold, short sell the high price bond. By doing that, he recovered or he got to his hands 900,000 rupees by short selling that bond. And from that, he would be in a position to purchase more than one of the other bond. More than one of the other bond. What is that? We calculated it. 900,000 divided by 785. So that is 1.1465 or something. He can get that. 0.1465 would be the additional amount. So then, when it is maturing, he would recover. He would receive 1,146,500 for him. Whereas he can only settle the bond he short sell. That can be settled by only 1 million. Because when it in maturity, it would be 1 million. No? So he can settle that for 1 million. When he settled 1 million, and he will retain 146,500 with him. That is his gain. Now that happens because he did the other way. What he did was, now say, what I'm asking is, if that person short sell 785,000, what would happen?
Will able to get
Then he could recover. He could get only 785,000 rupees.
yes.
Right? From that 785,000 rupees, how many bonds he can purchase in the other type of bond? So he could purchase only a fraction of that bond.
Yes.
And he would not recover even 1 million. So that is the issue. That is the issue. So therefore, I think by looking at the bond prices, a dealer would be in a position to take a decision. So dealer took that decision on the basis of the price of the bond, because he knew that in order to get a gain, he should short sell the high priced bond, and with the proceeds he can purchase more than one of the other bond. That is the underlying principle. You got my point? Then it would be very much advantageous for him, because on maturity you would get more than 1 million, because you are getting one and some fraction of the bond. So that fraction would be your gain.
Okay.
Right? So that is how it happens. So that is how the profitability is really maintained. So that is only one way. There can be several other ways of doing it. So can you remember that we did some portfolio management exercises where we calculated the duration, not only the duration, sometimes we calculated the convexity also. So by doing that, we are in a position to see what would be our alternative type of investment. So whatever. For example, say you have a portfolio with several bonds, say 10 to 20 bonds, and you know the weighted duration is so much, and you now, by going through the economic scenarios, the trends and all that, you would think there can be some interest rate increases in the future. Like nowadays, now in Sri Lanka also, we are now on the verge of a high interest rate scenario, higher interest rate, because now there will be signs. There are already, we have seen the signs of increase in interest rates. Signs of. When I say signs, it has not happened yet, but signs are there. Signs are visible. Inflation is going up at a high rate. That really triggers the market interest rates upwards. So that is the bad news. Now, when it happens, what will happen to the bond prices? Bond prices will go down. And if you have a high duration portfolio, the portfolio will have a high loss, big loss, depending on the interest rate hike. So that hike can be by 50 basis points, 100 basis points, 150 basis points, so on and so forth. So these are the things which a dealer has to think over on duration point of view. Then you have several other techniques to immunize portfolios and all, and we learned that also. Immunization, can you remember that? Because the duration can have a sign, say plus or minus. Now, in terms of assets, the durations are normally taken as positive. And in terms of liabilities, the duration is taken generally as minus. And pluses and minuses sometimes will have a cancelling off and resulting with zero. So that is what you mean by immunization. If you get a particular set of transactions, set of bonds, where you have short and long, that means you purchase bonds and you sell bonds. So there you have two different points, pluses and minuses. And through that, you will achieve an immunized portfolio. I think we did some examples on immunized portfolios where a particular pension fund is concerned, and a particular bank or the institution has to pay some amount for 4 years. Those amounts are taken as liabilities for a sinking fund type of a thing. And we calculated the duration of that. And that duration we equate with 2 bonds or whatever. And for that, we calculated the percentage of 2-year and 3-year bonds or whatever it is. So such type of things also we did. That is also taken as a methodology to deal with high duration portfolios or immunization of portfolios. Now in immunization, what you expect is to be safe, or be without having any type of a damage from interest rate changes or volatilities. These volatilities would not have any effect on immunized portfolios because there's no duration at all. If a high duration is there, you would have a high loss. If a low duration is there, you will have a lower loss. If the duration is zero, as I told you that when portfolio is immunized, the duration will become zero of that portfolio. That means whatever the change of interest rates, there won't be any effect on that immunized portfolio. That is why we call it is immunized. No attack from any virus can happen. The virus is the interest rate, ICO going down. But I think in terms of bond portfolios, interest rate hikes would be the issue, not the interest rate downturn. So the lowering or decline in interest rates would not be a matter, and it could be a good news for bond traders because their portfolios will go up in price or go up in value in a scenario where the interest rates are going down. Yes, any more things we need to you need to just clarify on this? And I think I want to just do another type of exercise here. And that is also very much important. Right. Right. I will now just put some other data on the board. Now here you can see this is these yields were observed in the bond market on 31st December 2021. Government treasury bonds, the yield is 9.5. The same, I mean, all are in the same tenor, right? AAA corporate bonds 10.10, AA corporate bonds 10.70, A corporate bonds 11.40, triple B corporate bonds 12.46%. So then the questions will be this. Right. The first question is determine the yield spread. Determine the yield spread for AAA and AA rated bonds. AAA and AA rated bonds. Right. Give an answer. Very easy. Now what you need to do is you need to get the yield spread for AAA and AA rated bonds. AAA and AA rated bonds. This is a very easy question. Yes. Easy question. Now I have put the yields of each type of bond. Treasury bonds yield is 9.5. AAA yield is 10.1. AA yield is 10.7. Yes. What is the spread? What is the spread for AAA and AA? In basis points, right? What is this 10 point? Yes. Now you should get it, give it in basis points, right? Basis points. Now when you say 0.6, it is not the case. It should be 0.06 if you put it in that manner. But it should be, you need to get it in basis points. Now just look at, so how do you get it? I think you need to get it that way. If you put it in percentage terms, then you can say, you have to say what? 0.60% for AAAs, 1.20% for AAs, is it? Just look at it. Now, how do you get the spread calculated? What is the spread? So, what is over and above the risk-free rate? What is the risk-free rate here? 9.5. So, what is the AAA bond rate? 10.1. So, 10.1 minus 9.5. So, that is what? And you get 0.60%. 0.60%. So that is how you have to put it. Now 0.60% can be given in another way. We call it 60 basis points. 60 basis points. Ruchira, now you said 60 basis points for AAA, right? Is that the answer? Yeah, 0.6%. Okay. 0.6%, right? 0.6% means 60 basis points. Yes. Right. Now, what is the other one? Say I asked for AAA and AA both. No? AA rated goods. What is the 120 basis? Yes. Good. These are an easy one. Nothing big here. Right. Then you just calculate the spread for A and triple B. A and triple B. A and triple B also just calculate. A and triple B. Yes. A and triple B. 120. A and triple B. 190. Yes. 190. So that is one A. And what is triple B? Yes. Good. Okay. I think these things are little easier. Right. Anything you need to clarify on this? Now, I think if you summarize the things now, it's like this. When you talk in terms of the spreads are really the risk spreads. And when you take the total interest rate, that consists of the real interest rate plus the inflation expectations plus the risk. So then we have come up to the inflation expectations. Now, when you say the treasury bill rate or treasury bond rate is 9.5 as given here, that 9.5 includes the inflation expectations, right? But over and above the things will come as the spread. Inflation expectations are not taken into consideration, I mean, when you calculate the spread. Anything else you need to clarify? Yes, Samit, you were silent along the discussion time. But anyway, now there are several other people who were silent. And anyway, I really think of getting more people into the conversation. But I have not been able to do that. Right. Anything else you need to clarify? Now, today we discussed on forward rates, yields, YTMs, and when you go for a particular period and for a period of several years, we calculate the mean type of forward rates, and even inflation expectations we calculate for several years, the average or geometric mean rate of inflation rates or whatever. So those were the things which we done today. I think these things are really critically important. I want to tell you something else also. In order to gain a good knowledge about these interest rate movements and all, and there's a press notice. I think that press notice was on 20th June. Sorry, 20th January, very recently. And you read that press notice or press release, you can get some idea about the Sri Lankan economic situation now. So that is a good reading for you. I ask all of you to read it and get the idea. Yeah, CBSL. CBSL. In the CBSL website, you get it. And not only that, you can read other things also. I just want you to go to the website and do some type of access into different areas. There are different links, and you can just go through the links and get some good information. Those information is very important for your studies. So I think that you do, and you can enhance your understanding by doing that. Right. With that, I think I might not be able to further do the discussion, and I wind up at this point of time. Thank you very much for all of you for your participation and very valid type of comments and all. I really appreciate those things. And I think now you have some comfortable level of understanding for these things. And I like to have others also get into the conversation. While doing it, you will be in a position to enhance your understanding on these things. Right? Thank you very much for your participation.